Melissa Hornbeck here with White Diamond Realty, and I really wanted to talk about interest rates. And we have been hearing a lot about the Feds rising the rates and the rise in mortgage rates and stuff. It was anticipated that we were going to have rising interest rates this year, but it was not anticipated that they would rise as quickly as early in the year. So here I am, you know how I am. I like to do deep dives and look at numbers. So I decided to do a deep dive of what this kind of change in the market is and what it kind of means historically. So these changing interest rates, and what does it all mean? So we always like to start with the big picture. Let's start with the beginning of the year, actually. So in January, the average, all of these rates, by the way, are from FreddieMac.com, which is one of the major holdings of mortgages with conventional mortgages. So average interest rate in January was 3.7, February went up to 3.8, 4.2 in March, and when I pulled these numbers last Friday, it was up to 5.2%. So from January to mid-April, we had almost a 1.5% interest rate, which when you look at that as a headline, it is really, really shocking. But let's not look at headlines, that's never a good idea. It's called clickbait, right? It just kind of sucks you in. Let's really take a look at what it means. So the bigger picture, let's take a look at historic trends. So the average interest rates have been tracked since the 70s. That's when they started tracking these interest rates. So let's go back all the way back to the last century, to ancient history. In the 1970s, the difference between the highest rate in the 1970s and the lowest rate in the decade of the 70s was 3.8%. So in the decade of the 70s, there was almost a 4% range in interest rates throughout that decade. In the 80s, it was a little over 6%. So we have 16.6% high in the 80s, 10.3% was the lowest in the 80s. In the 90s, there was a 3%, give or take, fluctuation in the interest rate. So this shows you that historically, at the end of the 20th century, that it is normal for the market to fluctuate throughout those decades. 1997 was when I first bought my house, and the average interest rate that year was 7.6%. So let's go back to this century, so a little bit newer in our history memory banks. In the first decade of the 21st century, there was again a 3% range in interest rates during that 10 years. But our immediate history, what we remember most and what we've been living with for the past 10 years, is only a 1% rate. So in the 2010s, we went from, the high was 4.7, the low was 3.7. So we have really been in this kind of utopia of steady interest rates for 10 years. And let's face it, that's just not realistically sustainable. First of all, they're obviously historically low. We hear that all the time, right? If you're looking over here, we've got 6s, 10s, 7s, even over here we have 5s and 8s. So it's already historically low, but it's not just historically low, it's historically steady. And that is what is starting to change now. We are still in historically low rates, but we are not as in historically steady rates, and I think that's very important. So this is the big picture, right? So this is what we're kind of looking at, like on a larger scale. But let's take a look at what that really big fat hairy deal. What about me? That's what we want to know, right? So what is the difference in interest rate mean to you, the consumer, who is out there looking for rates and such like that? So I kind of broke this down a little bit. So here I go again with my year-over-year comparison, okay? So 2020, the first quarter of 2020, your average interest rate was 2.7, 2.8, and 3.1 January to February, respectively, in 2021. What does this mean? So if you borrowed $100,000, only taking into consideration principal and interest, your payment would have been $408, $411, and $426 respectively. So that's a difference of $18 a month in this difference of about almost 0.5% of mortgage rate. Fast forward to this year, first quarter, January, February, March, 3.7, 3.8, 4.2, again, 0.5% difference. What that means is 457, 464, 487. So a difference of 30 months here, but we're in a slightly higher bracket. So if we're looking at the differences of these, this is about a 1% interest rate from the beginning of 2021 and the beginning of 2022. We're looking at 30 minus 18, 20, about a 22%, about a $22 a month change. No, that's wrong. It's $12. So that's $12 a month. Does that mean a lot? Don't know. It may mean a lot to you. It may mean that it's a difference between your debt to net ratio and whether you qualify for this amount of mortgage or this amount of mortgage. So this is a very personal effect on the finances. So what you need to be doing, instead of paying attention to all the TV reporters who are blabbering about this huge jump in interest rates, you need to be paying attention to your loan officer and your mortgage broker and saying, look, this is where I was a percentage ago, where am I now at this percentage? Especially if we're talking about here. So last Friday it was 5.07. Keep in mind that the Feds meet at the beginning of May again. So if you are seriously looking and you're concerned that they will raise the interest rates again, have a really serious discussion with your mortgage lender and see what you can do about locking in your rate. So if you have questions, don't turn on the television, pick up the phone and call your loan officer and see what happens. But hopefully this illustrates a little bit that, is it something that is different, and is it something that we should, oops, where I missed it, boop. There we go. Is it something that we should pay attention to? Yes. But historically, what we're doing is we're correcting. Our mortgage rate market is now correcting itself and going into what we usually do, which is the fluctuation. I actually had a meeting this morning, and one of my esteemed colleagues at Black Diamond Realty made the very important point that back in the 80s, when we were at 16.5% of interest, people were still buying houses. Businesses were still being opened. Things were still happening. Transactions were still transacting. They were just doing it a little bit differently. Looked a little bit different, okay? So don't panic. It's all good. Consult with your professionals, know what this means for you, and then just turn it to the Disney Channel because it's a lot more fun. Thanks. See you later. Bye.